What is going on, guys? Welcome back to another video. In this video we are going to go over what's better, weekly or monthly options, or even quarterly. So with that being said, let's go on ahead, cue the intro, and jump right into this one.
I know I'm fine, but the money
Okay
makes me.
guys, I get this question all the time now, and it is, which options are better to sell? Is it going to be the weeklies? Is it going to be 0DTEs? Is it going to be monthlies? Mainly it's a lot of people in between doing weeklies and monthlies. So we're going to look through this, and I want to show you the pros and the cons of both, and let you choose which one's going to better suit you. So first thing I want to do is I want to find a stock that I think everybody is willing to trade or be able to move that's not too expensive. It's going to cost you under $2,000 to trade this stock. So it's PLTR, and just so we can kind of see the chart where we're at with it. It's in an uptrend, so I'm okay with doing it. We are kind of downtrending though here for about the past month though. So options though, and you're selling it. So first thing first, we can go through the Yahoo and you can see both sides of this. So, but the one thing I really like to do is I think Robinhood does a very good job of laying this out, and it tells you how many days. So people do sell the 2 to 3 day DTEs, means days till expiration options. I don't think that there's necessarily a problem with this, but you better want to own the stock if it doesn't hit, or if it does get hit. So what do I mean by this? So we're going to go and we're going to sell a put. And it basically means at 16, you can get this one at $10. Now, the stock price is at 16.39, meaning if it only drops 39 cents, you're going to own this stock, and you have to be okay with this, and then being able to do the wheel strategy and cover call it the very next week or whenever you get these put to you. So that's $10. You gotta remember that's $10 on a 2 day. Or we can go out, and really you have to do these, or maybe this $3 one, but it's not really worth the money to pick up $3 by the time you pay the 30-cent fees and all of that. So you gotta be able to have enough on the bone in order to actually make some money that's worth it. I think that's the valid point there. We're going to go to 9 days because that'll be next Friday. So technically, it is a weekly option. All PLTRs are basically weeklies, and I think they got a few monthlies out there. But now you could do the same thing. I don't like the option here on this one here at 16. I'm probably not selling that one. I'm probably going more out here for $7 at the 15. That gives me a whole $1.39 to kind of play with, and you guys can see I'm just going to, just for the visual effect here, we're going to throw this one out here at 15. It's close enough. You give yourself some room to play with. Now, and again, this is really the main point here, is how much credit do you want to collect and how much time? Because you may be looking at it as 4 weeks. In a month, normally, I can collect that $7 4 times, and that does equal out to be not bad, right? On, your $1,500. I get it. Or you can go out to your 30 days, and I'm going to explain to you what I do here as well. You can get out here for a month. You're going to have less risk of getting put to it. You can do the same strike price. If you really want to own it at $15, maybe you do it at 30 days. Or your probabilities here, you're coming out here to the 90%, 12 or 13. You're collecting $20 or $11 here. There's a big difference here. I'm probably leaning more towards the 13 on this one, just because I like to be around, let's see what delta this is, 15. I was going to say around 20 delta, so that is probably right around there. That 14 is actually closer, but I would go with the 13 more compared to the 14. I'm going to collect $20 off of my $1,300. I think that's a decent return here for the month. Now, what I do on the S&P 500 and things like that, you're going to see March 1st, basically 45 days out is what I will do, and I will go out even further. For $1,200, I'll click the 13. I think that's a steal to me. I will do that, and now you're creating this spread difference here. This stock has to come all the way down here for me to get hit. In worst case scenario, I collect it. Now what you're not seeing is here, and I think this is the biggest point of them all, is a $12 one here In just a week, it's at 13 cents. In a week, a $12 has went down to 11. So you only made a couple bucks, but here we go. Now again, down to 11. I don't think that's quite right. But I think you're only going to have to hold this for about a half a month. So like 15 days, you're going to collect 8 cents. I think it'll actually be lower than that pretty quickly. But you're going to see when you get down here, you're going to collect, yeah, it's basically zero now at this point. So you did have to wait, a good couple weeks to get this, but you had less risk endured as well. And I think that's a big point with the monthlies and the weeklies. So again, I want to go to something though that more people trade with, and it's going to show you, or it's a bigger market is more what it is. SPY. This is one that I absolutely do this all the time with. And I'm very familiar with it. And I do these 45 days out, just so everybody knows I do them 45 days out. That's my cup of tea. It's where I can get the furthest out, collect a good chunk of premium still. And you know what? Sometimes if I want to, I can do it as a credit spread and reduce my capital risk. And if it is one that's going to get hit and I'm going to have to buy the stock, I just sell the call that I had bought for that. And I get out of it, and I reduced my risk a little bit more by creating a profit off that one and then selling another one. So I'm going to go sell a put here. And again, this is mainly for selling puts. I don't know why this was so far down. And you're going to see I'm going to go here, chance of profit. Oh, this is 2 days. We don't want that. Let's go for a week. I think 5 days because these are Monday, Wednesday, Friday expirations on these. So again, come down here. I'm probably looking at a 10%, so you can collect $80. I don't think that there's anything wrong with that. Or again, I like my 20 deltas a lot. You're gonna see it's 22. So yeah, see, I was right. I kind of knew where I was at with this one. $80, but again, remember what you are risking here on this. You're risking a lot more money to make a less return. Just remind that. That's why I enter a lot of them as credit spreads. In worst case scenario, I will buy the stock if I need to. But let's get rid of that one. That's a weekly. And now let's go out to how I would do it and how a lot of other people would do it as well. These are basically the mechanics of like Tasty Trade. But again, we add our own little twist to it. And I don't like playing the call side of it unless I'm playing a covered call. That's just my opinion. That's how I do things. So let's see what the deltas are here. It's too far out. That's my bad. Let's go with an 81. This is a 21. So now, see, I'm getting further out at a 455. So let's go put this at a 455. It's got to drop that much. And I'm going to collect $289 on this trade. I like this because what you will see happen usually within 21 days. We manage it at 21 days. So basically 20 days, 25 days. Then that week, you will see I'll be able to take this off for a 50% premium collected, 50% profit. It's not actually a 50% return on your money, but it's a 50% premium collected. I'll buy it back, and then I can either push out further and go into another trade, or maybe I go and trade a different stock like QQQ or something like that. That is what the difference is between monthlies and weeklies. Do you want to get paid on Friday, or do you want to get paid just less risk, but you still get paid usually about the same amount of money, and you don't have to end up buying this stock? Sorry, I'm almost over this cold, guys. I do apologize. So you really need to make a decision for you now when it comes down to cheaper stocks. Now, this is a key point that I do tell everybody here. When it comes down to stocks like a SoFi that I'm not in love with, or a Ford that I'm not in love with, I will trade these differently. Now, what do I mean by differently? I am trading the weeklies on these because if I get put to stock, I'm okay with it. I'm not going to panic about it. But I'm going to be able to instantly start running covered calls and reducing my risk. Rather than if I'm only going to be able to get out here. See here, 9 days. Yeah, see, I'm only going to be able to get out $0.50, $1.50. Not even, no, 50 cents here to collect $9, which is okay. But if you go out like what I was doing on SPY, 44 days, I gotta come all the way out here. Now I'm only risking $550 to collect $13, which isn't bad, but the stock's been at 5.5 before. Do I want to own it at 5.5? That's the big thing. And these premiums are a little bit higher because you've seen we've had this massive red days. So do you really want to own it at 5.5? That would be the big question for me. And right now, I'm probably not selling weeklies on SoFi because it is in a downtrend after some bad news. I believe they have earnings coming up next week. I'm not loving that trade there. So that is the main difference between the weeklies and the monthlies. How much are you okay with buying that stock and getting it put to you? Or, are you willing to just take a little bit less and get a little bit of a less risky return? That is your biggest question you have to ask yourself on this one. So thank you guys all for watching this video. I hope this helps somebody else out there. If you made it this far, comment below this far because I know you guys are my true followers. I'll see you guys in the next one.